You open your phone. There's a notification from your brokerage app. A stock you bought 3 weeks ago is down 18%. You tell yourself it's fine. You tell yourself this is just how investing works. But somewhere in the back of your mind, there's a voice getting louder. What if I'm doing this wrong? And here's the thing. That voice is right. Not because you're bad with money, not because the market is against you, but because nobody, not your parents, not your school, not that friend who got you into this, nobody told you the one thing that separates investors who build real wealth from beginners who just spin their wheels for years. They didn't tell you about the trap. It started with good intentions. Maybe you saw a video. Maybe a coworker mentioned a stock. Maybe you just got tired of watching your savings account earn 0.4% while inflation quietly ate through everything you worked for. So you downloaded an app. You put in a few $100s. You felt like you were finally doing something smart. And that feeling, that rush of finally being in the game, that's exactly where the trap begins. Because here's what nobody tells beginners. The market doesn't care that you're new. It doesn't have a beginner mode. There's no tutorial, and the moment you deposit that first dollar, you are competing, directly or indirectly, against algorithms, hedge funds, and people who have been doing this for 30 years, and you walked in with enthusiasm and a YouTube playlist. That's not an insult. That's just the reality nobody prepares you for. So what does starting wrong actually look like? Because it doesn't feel wrong in the moment. That's the cruel part. It looks like buying a stock because it's been going up, because your brain sees a rising line and interprets it as safety, as proof, as momentum. But what you're actually doing is arriving late to someone else's party, right as they're leaving. It looks like checking your portfolio 17 times a day, refreshing, watching the numbers move, feeling your mood shift with every red or green percentage. That's not investing. That's gambling with extra steps. And every time you react to a short-term move, you're making a decision based on emotion, not strategy. It looks like spreading your money across 12 different stocks because someone told you diversification is smart. And it is. But not when you diversify before you understand what you own. Owning 12 things you don't understand isn't diversification. It's just organized confusion. And it looks like losing 20% in your first 6 months, pulling out, and telling yourself investing isn't for people like you. When the truth is, investing wasn't the problem. The entry point was. Here's where it gets interesting. The beginner investor trap isn't really about picking the wrong stocks. It goes deeper than that. It's about what you think investing is supposed to feel like. Most beginners think investing should feel exciting, active, like you're doing something. And that instinct, that need to feel productive, is the single most expensive habit you will ever develop in this game. The people quietly building serious wealth in the market, they're bored, on purpose. Their portfolio sits there. They don't touch it. They don't react. They don't celebrate when it's up or panic when it's down. They made their decisions with a cool head months ago, and now they're just letting time do the heavy lifting. But nobody makes a YouTube thumbnail about being patient and doing nothing. So beginners never see that model. They only see the active version, the exciting version, the version that looks like investing but functions like a casino. And underneath all of this is a math problem that most beginners never run. Starting wrong doesn't just cost you the money you lose in bad trades. It costs you the years you spend learning the hard way instead of the right way. It costs you the compounding that never happened because you were too busy reacting to build a real position. Here's what that actually looks like. Two people start investing at the same age. Person A starts immediately, excited, reactive, chasing trends. They're in and out of positions. Some wins, more losses. After 5 years, they've broken roughly even. Person B waits 6 months, learns the fundamentals, builds a boring, systematic strategy, contributes consistently, doesn't touch it. 10 years later, Person B has 3 times the portfolio, not because they were smarter, not because they picked better stocks, because they didn't start until they were ready to start correctly. 6 months of learning cost Person B nothing. Starting wrong cost Person A 5 years. That's the real price of the beginner trap, not the money you lose, the time. So what does starting right actually require? Not a course, not a financial advisor, not a premium app. 3 things. First, understand what you're buying before you buy it. Not the ticker, not the trend, the actual business. What does this company do? How does it make money? Is it growing? If you can't answer those questions in 2 sentences, you don't own an investment, you own a bet. Second, build a strategy before you build a portfolio. What is your timeline? Are you investing for 10 years or 30? What is your risk tolerance? Not the theoretical kind you claim in a quiz, but the real kind, the kind that gets tested when your portfolio drops 30% in a month. Know that number before the market finds it for you. Third, remove the emotion from the execution. Set your contribution. Automate it. Stop watching it daily. The investors who win long-term are not the ones who react fastest. They're the ones who react least. Here's the uncomfortable truth. Most people who start investing never build real wealth, not because the market failed them, because they never stopped being beginners. They kept the same reactive habits, the same emotional decisions, the same excitement-chasing behavior, just with a longer account history. The trap doesn't just catch you at the start. It keeps you if you let it. And 5 years from now, you will either look back at this moment as the point where you changed how you think about investing, or you'll still be refreshing your portfolio, wondering why nothing is working, not realizing the problem was never the market. The question isn't whether you can become an investor who actually builds wealth. You can. The question is whether you're willing to be boring enough, patient enough, and honest enough with yourself to do it the right way. The market will be here tomorrow, and the day after that. The only thing that changes is how much time you have left. Your move.